Mortgage rates are rising right now. This specifically the fixed mortgage rates are rising because of what's happening primarily in the U.S. So we're seeing improving economic fundamentals down south, and the U.S. and Canada are very closely related economically. So the U.S. Housing market's coming back quite a bit. Year over year, price increases up 10% or so. So you're seeing some wealth effects down there that are taking place. So there's also on the Canadian side, we just had a blockbuster employment report number, 95,000 new jobs created. So generally speaking, when there's positive news in the economy, the perceived risk of inflation goes up. And inflation is the worst enemy of bonds. And the reason that's important is because fixed mortgage rates are geared to what's happening in the bond market. So if people are getting worried about inflation and they're selling bonds, there's an inverse relationship there between bond prices and bond rates. So bond prices go down, which is what's been happening, then the bond rates go up, and in turn the fixed mortgage rates go up. So if you're in the market for a mortgage, you want to get a rate hold, especially if you're looking at a fixed rate mortgage. So that doesn't obligate you to any particular lender, but it does protect you if rates go up. And if rates go down, then you can just reset your rate lower. So it's kind of a no-lose situation. So if rates are headed up, it's a question of will it keep going up? Because no one knows. So we've seen a big spike in rates recently. No one can tell whether that increase will carry through. So it's more a question of your personal circumstances. So can you afford to take the risk of a short-term variable rate? If you say for example your budget's kind of tight, and in that type of scenario, maybe a variable rate might not be so appropriate, because if interest rates go up about 2%, for example, the average mortgage holder, being someone that has about $175,000 mortgage on average, that's the statistical average, would see just under a $200 a month increase in their payment. So you have to factor in what your budget can withstand. Long-term, variable rates have been the better place to be, but we've also been in a long-term downtrend in rates. So the real question is your personal tolerance to risk, because no one can tell you where rates are going to go long term. So locking in a variable rate mortgage depends on a couple of things. It depends on your financial situation. So again, for example, if you have that average Canadian mortgage of $175,000 and rates go up 2%, you're looking at roughly just under a $200 a month increase in your payments. So can you withstand that? That's the first question. And the other question is, what rate do you have? So if you have, say, a rate of prime or prime minus 0.25, it's a whole different scenario than if you have a rate like prime minus 0.75, which would be 2.25% today, given where prime is at 3%. So if you have a lower rate, for a while, you're in a better position to withstand potential rate increases than someone that has a higher rate.